Hey guys, welcome back to our channel. And today we'll be reading an article that the Motley Fool has produced. It's under Investing Basics and it's under Investing 101, What to Invest in. So if you want to read along, you can. I think everything on this website has valuable and great information. Right now, we will be reading What to Invest in, Use Your Money to Make Money by Matthew Frankel. So let us begin. Why should you invest? Investing can be the smartest financial move you make. Although you might earn a steady paycheck from working, investing can put your hard-earned money to work for you. A wisely crafted investment portfolio can help you build tremendous wealth over time that you can use for your retirement, to send your kids to college, or for any of your other financial goals. However, while it's fairly common knowledge that investing is a good move, there's also the question of what you should invest in, which is an extremely important piece of the puzzle. With that in mind, let's take a closer look at some of the most popular investment vehicles. We'll discuss the pros and cons of each and examine whether they might fit into your ideal investment strategy. We'll also look at some of the things you probably shouldn't invest in. What to invest in right now? Starting investing can be rather intimidating, and one of the biggest reasons is that many people don't know what they can invest in or how to get started. So, here are some of the most common ways to invest money. Number one, stocks. Almost everyone should know stocks or stock based investments like exchange traded funds or ETFs and mutual funds. Stocks have consistently proven to be the best way for the average person to build wealth over the long term. US stocks have delivered better returns than bonds, savings accounts, precious metals, and most other investment types over the past 4 decades. Stocks have outperformed most investment classes over almost every 10-year period in the past century and have averaged annual returns of 9% to 10% over long periods of time. To put returns like this into perspective, a $10,000 investment compounded at 10% for 30 years will grow nearly $175,000. Why have US stocks been such great investments? Because as a stockholder, you own a business. For example, if you own shares of Apple, Alphabet, Google, or Amazon stock, you legally own part of the company. And as that business grows bigger and more profitable, along with the economy, you own a more valuable business. As legendary investor Warren Buffett puts it, investing in US stocks is a bet on American business. And this has been an excellent bet for more than 2 centuries. Some stocks also pay dividends, which can make them solid investment options for people looking for income from their investment portfolio. Number two, exchange traded funds or ETFs. If you're worried about researching and selecting individual stocks, an alternative is to invest in ETFs and or mutual funds. For example, if you invest in an S&P 500 index fund, your money will be spread out among 500 companies that make up the index. So, if any one of them were to fail, it wouldn't be devastating. Number three, mutual funds. Mutual funds are similar to ETFs. They pool investors' money and use it to accumulate a portfolio of stocks or other investments. The biggest difference is that ETFs trade on major stock exchanges, and you can buy shares whenever the stock market is open. Mutual funds only price their shares once a day and aren't nearly as liquid. Number four, bonds. Over the long term, growing wealth is the most important step. But once you've built that wealth and gotten closer to reaching your financial goal, bonds, which are loans to a company or government, can help you stay there. There are three main kinds of bonds: corporate bonds, issued by companies; municipal bonds, issued by state and local governments; and treasury notes, bonds, and bills used by the US government. You can buy individual bonds through most major brokers. But for most investors, the best way to go is to buy ETFs and mutual funds that invest in bonds on your behalf. Number five, high yield savings accounts. Savings accounts offered by branch based banks are notorious for paying minuscule interest rates. However, some excellent banks, primarily based online, offer very competitive rates to the point that they can be considered investment worthy in many cases. Number six, certificates of deposits or CDs. Many reputable banks offer some excellent high yield certificates of deposit. They pay guaranteed yields for anywhere from few months to 5 years or more. Unlike savings accounts, CDs can allow you to lock in a specific yield for a set period. Number seven, real estate. Like owning great companies, owning real estate can be a wonderful way to build wealth. In most recessionary periods throughout history, commercial real estate has been counter-cyclical to recessions. It's often viewed as a safer, more stable investment than stocks. There are ways for people at almost every financial level to invest in and make money from real estate. The most obvious is to buy rental property, which can be a great way to build wealth and create an income stream, but it isn't the best fit for everyone. Fortunately, there are alternative ways to invest in real estate, many of which are more passive than actually becoming a landlord, such as real estate investment trusts. Publicly traded REITs are the most accessible ways to invest in real estate. REITs trade on stock market exchanges just like other public companies. Here are some examples. American Tower owns and manages communication sites, primarily cell phone towers. Public Storage owns almost 3,000 self storage properties in the US and Europe. Algon Bay Communities is one of the largest apartment and multifamily residential property owners in the US. REITs are excellent investments for income since they don't pay corporate taxes as long as they pay out at least 90% of net income in dividends. Number eight, cryptocurrencies. Cryptocurrencies are relatively new from the investment vehicle. Popular examples include Bitcoin and Ethereum. If you have a knowledge of cryptocurrencies, they can be incorporated into diversified investment portfolio. Your investing approach. No investment approach works for everyone. So, to figure out the best way for you to invest your hard-earned money, here are some things to think about. Your risk tolerance. Stocks are not risk-free investments by any definition. Even the most stable companies, stocks can fluctuate dramatically over short periods of time. Over the past 50 years, the S&P 500 has declined by as much as 37% in a single year and has risen by as much as 38%. On the other hand, bonds and other fixed income investments don't have as much long-term return potential as stocks. Nonetheless, they make up for it with a lack of validity. Generally speaking, stocks, stock-based ETFs, and mutual funds are most appropriate for people who won't need their money anytime soon. On the other hand, fixed income investments are best suited for investors whose primary goal is preserving their capital. Time horizon. If you have a kid heading off to college in a year or two, or if you're retiring in a few years, your goal should no longer be maximizing growth. It should be protecting your capital. It's time to shift the money you'll need in the next several years out of stocks and into bonds and cash. If your goals are still years away, you can hedge against volatility by doing nothing. Even though some of the worst market crashes in history, stocks have delivered incredible returns for investors who bought and held. Investment amount. If you have $500 to invest, you can certainly still get started. but your approach will likely be significantly different, and your options will somewhat be limited compared to an investor with $100,000 to get started. As an example, if you want to buy rental property, you'll need enough money for a down payment. If you want to put money in a high yield CD, some of the best options have minimum investment requirements. Knowledge level. Investing in individual stocks can be a great way to build wealth if you have the time and knowledge to do it right. If you don't, there's absolutely nothing wrong with investing into ETFs or mutual funds to get exposure into the stock market. In short term, some types of investments require more knowledge than others. If you want to become a successful stock market or real estate investor, one of the best investments you can make is to accumulate as much knowledge as you can before you put any money at risk. So, what should I invest in? To be perfectly clear, every investor is different. There's no rule of thumb that works for everyone. However, for most people, the answer is a portfolio that combines stocks and fixed income investments like bonds and CDs. One popular asset allocation guideline financial planners use is to subtract your age from 110 to determine the approximate percentage of your portfolio that should be in stocks. For example, according to this rule, a 40-year-old should have roughly 70% of their money invested into stocks. So that is the article. Thank you guys for listening to me read. It also gives you guys related investing topics, what type of investment account should you use, and other great information like that on the website. There's more articles on the motleyfool.com. It's really simple to use, really easy to find. I would like to shout out the Motley Fool again for letting us read from their website. Check them out. And don't forget to leave a like, comment, and subscribe if you guys enjoyed this video. It really helps us a lot, and we really do appreciate it. We'll see you guys next time. Bye.